So next we will look at Meta's third quarter earnings. I've recently bought into Meta. So you notice that the difference between stocks and property is that for property, the prices are very stable, but it's an illusion because it's very illiquid. And people take a long time to decide because if you have mortgage and you live there, then you do not sell it quickly. And it takes about 3 months to 12 months to decide to sell. So in a war situation or emergency, property price can plunge 30 to 40% and you can't find a buyer. It's illiquid, right? So most of the time it's stable. Okay, but stocks, the advantage, okay, the idiosyncrasy of stock is that a lot of people are buying, selling. It's very easy to transact. And sooner or later, a high quality business, the CEO or the senior management can say something that the market doesn't like. So those people who do not understand what they're buying will sell in a panic. And that's where you get to buy it. So take advantage of this animal. So let's look at the financials of the company. The stock price plunged over 10% recently due to a dip in earnings per share and the announcement of increased CapEx. However, it's important to look at the top line growth, which is 26%. So earnings per share plunged 83% due to a one-off tax bill. I would rather invest in a company with ever-growing revenue, with a temporary dip in net profit, because they need to spend something, there's CapEx to do to improve the company so that in future they can earn more than a company with falling revenue and rising net profit, which latter means cost cutting. And if tax rate were to be normalized, net income would have been 18.64 billion, which is an increase of 19% year on year. So you need to normalize all these one-off things. So expenses rose 32% year on year. I encourage you to look at the data instead. Look at the third quarter results in the company website under investor relations. So family daily active people is up 8% year on year, ad impressions up 14% year on year, average price per ad up 10% year on year. The management has guided on strong ad revenue growth 20 to 30%. Expenses will be higher, 24%, and CapEx is going to be larger next year. So lower earnings per share and free cash flow. Okay. A lot of the costs will be in infrastructure, incremental cloud expenses. Is that a bad thing? No. The answer is no. Look at the top line. 21% revenue growth, 9 months to date for FY25, financial year 25. Family of apps income up 22%, income from operations up 27%. So income from operations excludes the one-off item, so it normalizes, and you can see that business underlying is doing very well, it's growing. Now, the animal of Meta is that 98% of the revenue comes from advertising, which is very sensitive to economic growth worldwide. Family of apps, 122% of operating revenue, because Reality Labs is loss-making. So operating margin is about 45% effectively. So the average effective tax rate is 13%. So the one-off of 87% shouldn't shock you. You should normalize the tax. And diluted earnings per share plunged due to a one-off tax charge. So this should be totally ignored, right? So earnings per share is the last thing you look at. CapEx jumped 105%, which is normal for a company that's preparing itself for the next growth phase. And the family daily active people is rising 8% year on year. Average revenue per person generated is up 18% year on year, $14.46 for the third quarter of 25. Geographically, growth engines are in Europe, US and Canada, rest of the world. Asia ex-Japan is flat. Now, next thing is that Meta announces joint venture with funds managed by Blue Owl Capital to develop Hyperion data centers. So this is off-balance sheet financing, where Meta owns 20% of the SPV. Probably there might be a corporate guarantee given. So off-balance sheet financing is a yellow flag, it's not a red flag. You will still need to monitor debt levels. I would say that if the company's debt to equity is still at 0.5%, I'm okay with it. That is a very healthy level of debt. And most of the quality companies have very low debt. So revenue growth, and debt levels manageable, 0.5 thereabouts. Anything above 1 is tough. So I would say that this is still okay. Stock price have plunged below the 200-day moving average, below support lines. There's a lot of heavy selling. I would say in such a sign, it's actually a good time to pick it up. Now, technically, it is a good time. It's a pullback. So value and quality investors like this style pullback. Is it below fair value? Well, we can use a lot of DCF calculators. So I use the Stock Oracle one. We do a 3-stage model because the business is likely to be viable in 10, 20 years' time. So first of all, we must remind each other, assume a 10% discount rate, which is the S&P 500 returns. You can also use the WACC, okay? That will be slightly higher. Now, we assume 18% growth rate of free cash flow for the first 5 years, falling to 13.39% from 6 to 10 years. Finally, 4% growth rate to perpetuity. You arrive at about $704 fair value, and it is at fair value at this moment, around that level. But the last thing you should know is that valuation is the last thing you need to look at, because it's not a point estimate. Valuation is a guesstimate of future. More important is whether you think the company will continue to thrive for the next 10 to 20 years. And if you think that the company will still be there, don't get hung up about the valuation. Just know that 90% of Meta's business is from advertising via the family of apps. And as long as your friends, family, or you continue to use them, they will stay relevant. So they are generally a B2C company with a wide moat in communications network. People's habits do not change suddenly. There will be warning signs where the revenue drops, the DAP drops, people will use less and less of the apps. So in terms of quality, I will rank other hyperscalers like Amazon, Microsoft, Alphabet as better quality if they have more diversified revenues from cloud, software, logistics. So I've come to the end of my presentation. I'll see you soon for the next one.